a little bit about the level 2 window, what it actually really means. It's called depth of market, depth of book, the market depth, level 2 window, different names, but it all means the same thing. We're going to talk a little bit about high frequency trading. Why I personally avoid trading spready stocks. Okay? This is what you're going to find really eye-opening, by the way. Now, the first part of the discussion is going to be about what not to do, or why, and then later on, or why I wouldn't, I'd stay away from spready stocks and how to read level 2. And then the second part is going to be on how to do it, what to look for, how to do it, and then we'll end with the top 10 rules for level 2 scalping. Notice this week, we haven't really done much scalping off the level 2, right? Because that's not right now the focus. It's not because it's not the style that's, that yields the best profits right now. We're in the middle of earnings season, and also just like any and every style in trading, it changes from time to time. Like sometimes earnings plays, sometimes is what is making the money. Sometimes it's day trading, sometimes it's swing trading, sometimes even, day trading, but trading the charts. Sometimes it's doing the gaps at the open, sometimes doing the afternoon plays. You never know, right? So you have to be all eyes and ears and just listening to the message of the market. By the way, ENVX lower again, but I'm not going to do it. HCMP, but it's too late now on the HCMP, higher. So ENVX lower one more time if anybody wants to try it. But at any rate, so the market, this is the hardest thing I would say about trading, is that you have to adapt to the ever-changing market environment, and not just like different. Right now we're in a bearish market. We were in a bullish market for the last, 12 years maybe. Okay, but that's not all. You also have to adapt to the whatever is working. You have to take advantage. You have to trade whatever is working, whatever strategy or style that's working the best right now. So that makes, I think, trading a little bit more difficult than the average job, where you don't have to adapt at all. You just do the same thing every day, and expect the same outcome. But in trading, we have to adapt, and that's hard. I think for most people, change is hard, and it's not easy for me. But the moment I realized it, which was in 2012, I think, is when I really realized that you have to change. You have to adapt to whatever the current market environment is providing us, is telling us to do. That was pretty eye-opening, but it cost me a lot of money before I could do it. So okay, so keep that in mind. So let's get started. So first, we're going to talk about level 2 trading. We'll start with the basic stuff. What's the bid? The bid is the highest price a buyer is willing to pay for a stock at the current time. The offer is the lowest price a seller is willing to accept for the stock at the current moment. Okay. There's a minimum of 1 cent spread. Often it's a lot more on stocks trading above $1. There's always going to be a minimum of 1 cent spread. Now, does anybody know why the spread was created to begin with? It was created as compensation for market makers, and they're called market makers on the NASDAQ exchange, and specialists on the New York Stock Exchange, as compensation for them willing to be the buyer and seller of last resort, because that was their job, to be the buyer and seller of last resort. So to compensate them, the spread was created, and while the market is stable, they're constantly, capturing the spread, the bid and the offer. I mean, the difference between the bid and the offer, and that's the spread, right? The difference between the highest price a buyer is willing to pay and the lowest price a seller is willing to accept. So as compensation for them to be willing to accept to be willing to accept to be the buyer of last resort, seller of last resort. I better stop looking at the thumbnail charts because I'm getting distracted. Okay, so this is the highest bid, the first level that you see on the level 2, right? This is the lowest offer. It's called the National Bid Best Offer, NBBO. Okay, that's the lowest ask. And the difference between the two is the spread. Level 2 data is when you see the different, it gives you a depth of, that's why it's called depth of book, depth of market, because it not only shows you the highest bid, lowest offer, but it shows you the other bids below it and the share size, the volume. That's called level 2 data. It shows you the aggregated volume at each price. Okay, level 1 data, it shows you the highest bid, highest ask, the total volume at each, and the low the day, high the day, and total volume for the day. That's level 1 data. Okay, so level 2 data shows you the depth. Level 1 data, this is just FYI, is provided by the Consolidated Tape Association, the CTA, to registered brokers. Brokers provide that information free of charge to non-professionals. Level 2 data is provided by the 3 exchanges. There's only 3 exchanges. I don't know if you knew that. And they have 10 subsidiary exchanges. 10 or 11, I'm not 100% sure. So it's the NYSE, NASDAQ, and COBE. Everything else is a subsidiary. But level 2 data is historically wasn't free, and brokers passed on the cost to traders. Not these days, but in the past it used to be. You had to pay for it. Level 1 data is technically all you need to place a trade. This works for investors, but if you're a day trader, learning to read the depth provided by level 2 is crucial. The depth of book shows you all bids and asks where volume accumulated. All right. It shows you where pockets of supply and demand exist. More importantly, it shows you how liquid the stock is and how far the next bid or offer is from current price. This gives you an idea of how liquid the stock is and what kind of execution you should expect to get when you try to buy or sell the stock. Okay, in other words, it shows you how liquid or how wild the stock really is. Okay, now I don't want to get too technical with you here, but there's a difference between spready and jumpy, right? You often use these words interchangeably, but that's not quite right. Stocks that have a wide spread between the bid and the ask are called spready stocks. Stocks that lack a deep level 2 are considered illiquid, and those are jumpy usually. Okay, so you got it? So some stocks have just a wide spread. They're not jumpy, but they're very spready. Some stocks are not very liquid, and therefore they're usually jumpy. So you send an order and it jumps. Now, the spreadiness and jumpiness of a stock is controlled by the market maker and the specialist. There's a direct correlation between the more volatile and liquid the stock is, the more spready and jumpy it is. Direct correlation between the volatility and the liquidity of a stock and how jumpy and spready it is. I think most of you already know this. Okay. Now, high frequency trading systems exacerbate the volatility of a stock to their advantage, big time. For years, brokers have sold their clients' order flow to HFT firms, which they did that for a reason, because HFT firms worked the order flow. They profited off traders' orders. This in turn made stocks much more jumpy and volatile. From Wikipedia, here's one way high frequency trading firms take advantage of our trading. We send an order. Most of the time, it doesn't even go to the to the exchange anymore. Your order actually goes directly to the market maker, and who knows what they do with it? Who knows? But even if you were to send the order to the exchange, they intercept it. This is why most of their servers are sitting on the floor of the exchange or right outside the building the exchange is building, whatever exchange they're, they're filling orders off of, or filling orders on, because they want to be, they want to intercept your order and have the fastest response rate to when sending an order to the exchange. So they intercept your order, they read it, and then they do all sorts of things with it. In this case, they read your order. This is from Wikipedia. I'm not trying to be controversial at all. Now, you can also read Flash Boys. That's a pretty good book to read if you want to know what they do with your orders. It's called Flash Boys, and by Michael Lewis. So they read your order. They also they see that the exchange A doesn't have enough shares to fill your order. They buy the rest of the order and sell it at a higher price on exchange B. In the meantime, that causes the stock to jump because they buy all the shares available and then dump them all at once. Creates that extra volatility. But that's just one way HFT firms work your orders. Okay, to their advantage, clearly to their advantage. All right, but we're not. I don't care. It's not like something we can do anything about it. But it's just an FYI kind of thing. Okay. Now I shy away big time from spready and jumpy stocks because it inhibits precise order execution. You can't really enter, but especially exit at the price that you want. You saw exactly what happened with me with Inky yesterday. Okay, Inky was up like over $2,000 for me, and I couldn't get out because it just flipped so quickly and so spready, and it's so spready that if you hesitate for just a second, it's too late. It becomes too late to exit, which exactly what happened with me on Inky yesterday. It had maybe 25-cent spread, and that's not like outrageous, but it's 25-cent spread. It prevents you from managing and controlling risk. When it's spready, I don't know how much room to give it. Like, I don't want to get tagged if I'm lowering my stop, if I'm in a short or raising my stop. I don't want to get tagged. And when there's wide spread, I don't know how to manage it really well, right? I usually have to give it room, and then when I finally get filled, I get a horrible fill. So it prevents you from managing and controlling risk. It exacerbates mistakes. If you're late 1 or 2 seconds, sometimes it can completely alter the result of the trade. If you make just a mistake by entering an extra zero, entering 1,000 shares instead of 100 shares, I've done that a million times, can totally ruin your week. True story. My worst trade ever was on a stock called TQNT. It got bought. It was like a $5 stock, very liquid. I was up $4,500 on it, and I had 10,000 shares short. I went to cover it, and instead of covering 10,000 shares, I covered 100,000 shares. So I ended up going long 90,000 shares. Now, I did it on Sterling. In Sterling, this is the Sterling. Oh no, you can't see it. Okay, no problem. So in Sterling, there's a setting that allows you to actually set a maximum share size per order. Like it's a soft limit, and if you exceed it, you get a pop-up message saying, "Are you sure?" I didn't have that set at all. It was a blank field, and so it totally filled my order, and then it started to drop. So when I was up 4,500, by the time I got out of it, I got out every time it dropped 1 penny against me. I got out of 10,000 shares. I had 90,000 shares long, and being up $4,500, I ended down $9,500. So it was a $15,000 loss in just a few minutes. Now I also learned something that from my broker, because I called him at the end of the day, And that was when I was just, I was relatively, newish to not new, but I hadn't been trading for years and years and years. So that was like a huge loss for me. So I talked to him and he said, you should have called me. I could have potentially canceled the order for you. And it's true. If you ever make that mistake of, buying a trade that you didn't mean to buy, reach out to your broker immediately. They usually have 20 minutes to call the market maker and see if the market maker is willing to bust the trade. It just recently happened on SIVB, just 2 months ago. I was on the mic and I bought, it was a $500 stock, I think. It collapsed. And I bought, or 450. And I bought 2,000 shares. I didn't even mean to type SIVB in my level 2. I meant to type something else. I don't remember what the symbol was, but the symbol came up SIVB and I bought 2,000 shares. And it was $450, $470 stock. You can check it out. I called them. I didn't call them right away because the stock was moving up in my favor, but then the spread opened up to $2, $2 to $4 spread on the SIVB. I thought it's moving up in my favor, but with the spread, I'm gonna get killed. So I called them, maybe even past the 20 minutes mark deadline, and they still busted the trade for me. And that was just, like I said, a couple months ago. So I didn't know that at the time, and it cost me $15,000. And that wasn't even a spready stock. It had only 1 cent spread. Okay, so imagine I shorted one time 1,000 shares of Tesla instead of 100 in less than a minute. No, in less than like 5 seconds. I lost $3,000 when Tesla before the split, before the 5-to-1 split, and then later on 3-to-1. So if you make a mistake, we make mistakes all the. I make mistakes all the time. But if you make a mistake on a spready stock, God help you, right? Now, worst of all, you are paying dearly for the spread and the jumpiness. Most people just don't know it. Here's some math for you. Imagine, you a trader or yourself averaging 5 trades a day, 1,000 shares a day. I do more than that. Even when I'm not scalping level 2, I probably do more than 10,000 shares per day. I'm pretty sure I do. Okay? Even when I'm not scalping the level 2. But let's just say, 5 trades per day at 1,000 shares a trade. Round trip, that's 10,000 shares per day. We have 253 trading days in the year. On average, that's 2.5 million shares times 1 cent spread. That's the minimum. It's cost, the cost that you have to, that you pay for the spread is 25K. So, okay, 2.5 million times 1 cent is 25,000. Imagine if on average you traded, 5 trades, 1,000 shares a piece on stocks that had 10 cent spread. I think at the open, the what was it? ENVX that we took this morning probably had, I don't think it had 10 cents, but close. So that's 253,000 a year. That's money that you need to make before you can even break even. Did you know that? When I worked through the math, it shocked me. But it's true. That's money that you have to make before you can even break even. Okay? That's 250K if you're trading stock with 10 cent spread. So this is why I shy away from the big names. Some people like them for options, for trading options, but I don't do options. So as a day trader, I shy away from the pricey stocks because they tend to be really, really spready. But that's not all. We have not even considered slippage. Slippage, so we talked about spreadiness and jumpiness. But slippage is when your order slips below the highest bid, lowest offer, if you're trying to cover the high. So slippage happens when your order gets filled at a price different than the highest bid, lowest offer. Okay? Slips below the bid when you're selling or when you're shorting. So spready, jumpy stocks. Slippage happens when you order. Okay, I already read that. Spready and jumpy stocks lead to excruciating amount of spread. Slippage. Slippage and spread are two different things. Got it? Two different things. Add the two together and it's easy to see why a lot of traders lose money even when they are taking good trades. Okay, it's crazy, but it's true. So the solution is whenever it's possible, stay away from spready and jumpy stocks. It's just the way it is. Stay away from them because you're gonna need to make the money back that you spent on the spread. Okay. Trade stocks that are non-spready and that are really liquid, that have, the level 2 is very deep, a lot of bids, at a lot of shares at each bid. Unfortunately, the most liquid stocks and the least spready are name brands, except that they're dominated by HFTs and algos and bots and all computerized trading, basically. Which, what does it do? It works your order. It does this. And that's just one example of how they do it. So, it makes even the name brands that you're supposed to focus on, it makes them jumpy. Not spready, but jumpy most of the time. I used to marvel, and not in a good way, I used to wonder how this stock that I'm scalping, that has traded 50, 100 million shares for the day, I'd try to scalp it sometimes with 5,000, 10,000, 3,000 shares, and it would make it jump a penny or two. I used to think, and I still do, how could that be? This stock has done 50 million shares, however much, 10 million, 20 million. I'm just buying 2,000 shares, 5,000 shares. Why would it make the stock, and why would I be getting partial fills? Why would why do I see thousands of shares on the offer, 10, 20, 30, and I buy a few thousand and then I can't get filled more? It jumps to the next level, up. Because they're buying the rest of the shares. They read your order, they buy the rest of the shares, and now you have to pay more if you want to get filled on the rest of your order. So, and this happens on really liquid stocks because they're completely dominated by HFTs. I don't know how it's legal to this day. I mean, honestly, I just don't know how that's legal. But it is. And I'm not complaining about it because without HFTs, we probably wouldn't have commission-free trading. We probably wouldn't have commission-free trading. So I'm not complaining about it, but it's a mechanism. It's something that you have to understand because it affects your trading. Okay? Always use limit orders for entries. I don't even have a hotkey set up for a market order. Like when a stock is moving fast and I want to get in, sometimes I miss out because I don't even have a hotkey like I do for all my orders. I don't have a hotkey for a market order. I don't. Only for the exit I do. It's the escape button. I hit it. If I'm in a position, it closes out the position for me. But for entries, I always use limit orders. Consider using wide limits for your exits instead of a market order, which is what I normally do. Consider using wide limits. Another true story for you. I used to trade with a broker called Legend Securities long time ago. I was trading on a route called, on Sterling, you can pick whatever route you want. If you have Sterling, I tried to show you Sterling, but when I put it over the text, it still wouldn't show. Let me see. Yep, still doesn't show. Oops, what did I just do? Hold on, I'll bring it back up. The whole thing just went down. This should be it. I don't know where the room went, but it's fine. So Citadel, I used to use their platform, their route to place my orders. It's the most liquid. It's the biggest, biggest firm in the country. So computerized HFT firm, computerized trading. Citadel called my broker and said, and I used to, that year at least I was really active and whatever. Called my broker and told him, this trader, and they gave them my trader ID. Each of you has a trader ID, like an account number. They said, this guy needs to use market orders, otherwise we are pulling the route from the firm. So my broker reached out to me and said, here's what happened. And I can't afford your, like, my most active trader, so he's making great commission off me, but I can't afford to use this route that 2,300 traders used at the firm. 2,300. So if I see you place another limit order, I'm canceling the account for you. And I was like, my jaw dropped. I wanted to still use Citadel as my route, and it was CTDL, but at the same time, I thought about filing a complaint. What do you call it? Like sending a complaint to the SEC, reporting them. I thought about it. I didn't do it because I thought, what's in it for me? If I do so, and something happens, I'm still gonna lose the route. So I didn't do it. But they wanted me to use market orders and not limit orders. Why? Why do you think they wanted me to use market orders? Because they could, even though they're supposed to legally fill you at the NBBO, the National Bid Best Offer. They're legally supposed to. Yeah, with a market order, it's pretty hard for you to argue that, to say, oh, why did I get this fill? It's a market order. If you wanted a better fill, you should have submitted a limit order. They would tell you. So they wanted to take advantage, and that's illegal. So that's why I thought about filing a complaint against them, but I ended up not doing it. So really recommend using limit orders even for your exits, but use a wide limit to make sure you get filled, not a market order. Okay? All right. Now we talked about level 2 trading. We talked about all kinds of things, right? Now we're going to talk about scalping. Okay? And there is a misconception that scalping results in small profits, or that it is not a valid strategy, or that it is stressful. That's a misconception. Nothing could be further from the truth. Nothing could be further from the truth. During the March craziness, in 7 trading days, 7 days, that's my P&L from E-Trade, P&L from Sterling. In 7 trading days, I made 195K in 7 trading days. Now, you might say, well, just those 7 days? No, I mean, the whole year was good. Right now, like I said, I'm going to take this down. I don't know if I take it down, would I be able to show you? Like if I wanted to show something? Nope, it doesn't come up. Oh, I know why. 1 second. I think I know why. Hold on 1 second, please. I think I know why. Because take me just 1 second, okay? I think that should do it, but I don't know if it's gonna work. Nope, it's not. Okay, well, whatever. I was just gonna show you something, but it's okay. We'll continue. So scalping is, I make more money scalping than any other strategy, probably. Right now, gotta take the foot off the pedal because it's not probably the most lucrative strategy, but I want to show you how to do it, how I do it. Okay. So first, how do I find scalpy stocks? Most of the time, I look for not at the open necessarily, but later on in the day, I look for really tight uptrends, really tight downtrends. Look for unidirectional trends, then scalp the microcycles within those trends, using the level 2 to perfect your entries. Something like this, just an all-out bullish uptrend. So every time it pauses, you get a pop, and then you can take advantage of each little pop on the way up or each little drop on the way down by watching the level 2. Right now you might say, well, what am I watching? What am I looking for? I'll show you in a minute. But that's basically, those are the ones that make for the best scalps, even if they're not purely level 2 trades. Those nice unidirectional trends that are just nice grinds with a lot of momentum. And the best ones, I would say, are oops, hold on, messing up here, are these. something like this, where every bar is red and it's just really tight, and then eventually accelerates and becomes climactic. So this would be like the best kind of chart to find, but not while it's down here, while it's still on the way down. That's a really nice chart. Now, you're not going to find charts like these unless you begin with a daily chart that's really bearish, such as this kind of chart. A gap down after a breakout the previous day, right? Significant failures on the daily chart make for the best power trends. Or that chart, similar, very similar, not the same stock, but very similar. Or, you know, so those are the failure patterns on the daily or gaps on the daily. Those make for the best unidirectional trends that you can just continuously look to scalp. Some people often, complain to me and say, hey, can I, why can't I focus on just one or two symbols? You can. Feel free to focus on just the same symbol. But find something like this first. Find something that has a nice tight uptrend or downtrend. And then short every time it reaches the 20 and then takes out the prior bar's low. See what I mean? And like I said, that's like the best kind of chart you can get. Now, how do you time your entry? When do you do it? When you're playing long, you want to do it whenever you see an imbalance between the bid and the ask. Imbalance meaning, you have a strong bid, in this case 50,000 shares on the bid, only 3,700 shares on the offer, and the stock is bullish. That's when I jump in long, buy the offer, right? Short the bid. Really strong offer, 30,000 shares. Sometimes we see 300,000. And then 1,600 shares on the bid. Here's a $5 stock. This was a $26 stock, $5 stock, $6 stock. 29,000 shares on the offer, only 1,600 shares on the bid, and the stock is weak. Stock is in a downtrend. That's precisely when I want to hit the bid, because there's not a lot of bids, and yet, even if I don't, sometimes I would just play it off the level 2 even without paying attention to the chart very much. Why? Because I know that if I get in at the bid, the worst fill I'm gonna get is the offer, which is 1 cent. I lose a penny. Now, if it's a jumpy stock, if it's 573 by 574, and then the next, when it starts to get bought a little bit, it goes to 580. 590, then yeah, that's not a stock you wanna scalp at all. Does that make sense? So you want to focus on the ones that are non-spready, non-jumpy. Here are the top 10 rules for playing the level 2. So first 2 rules are not jumpy, not spready, because it will be really hard for you to make money scalping something that's jumpy and spready. It'll almost be impossible. You might make money on one stock and lose money on 10 other stocks if they're jumpy and spready. And we talked about how there's a difference between a stock being jumpy and a stock being spready. They're not the same thing. We want to focus on level 2s that have an imbalance. Why do you think we talked about the RLX this morning? Remember the RLX this morning? Talked about because it popped at the open because it's very liquid, and there was that imbalance, strong bid, weak offer. So focus on level 2s that have an imbalance, that are highly liquid. Okay, very liquid, and most of the time it's not a must. It's not really a must, but it's a very nice thing to have a catalyst. To have a catalyst such as a gap, a failure on the daily, a breakout on the daily, price is breaking out, or a pattern is triggering on the daily, a climactic buy setup like the LI, the LI. So something really interesting about the daily chart. So must have a catalyst. Maybe some news came out in the middle of the day. That works too. But something that's driving the price of the stock, which creates momentum. Without a catalyst, you're not going to have much momentum most of the time. So what you really want is momentum. To get the momentum, you want a catalyst most of the time. If you don't have a catalyst, you're not going to have momentum 90% of the time. Which is why I don't just trade the name brands. Like, I don't just wake up every day and trade Apple or Tesla or Amazon or Google. Every day my list is different. Every day. Must have a trending 20 MA, not flat, because flat means no momentum. Flat, you buy it and it goes nowhere. You short it and goes nowhere. You're just gonna be losing money or breaking even the whole time. Always scalp with the trend. The exception is if it goes climactic, you can scalp against the trend, but I find it really hard to make money scalping against the trend. Stop scalping if the stock gets a spike in volume, because it will stop following. It won't follow through anymore most of the time. Let's say it's going up, and you're buying it and you're doing well, and it gets a really big spike in volume or goes climactic. The stock goes climactic. You will most likely not make any money if you continue scalping it. So stop scalping it if it gets a spike in volume, and stop scalping it once momentum is lost, because it at some point during the day it gets lost. Not everything that has momentum, most stocks that have momentum, at some point they lose that momentum. How can you tell it lost the momentum? You start to see, you don't see, this is momentum. I'll show you. This is momentum. Red. You don't see multiple red bars in a row at a time. You start to see one red bar, one green bar, one red bar, the Christmas tree effect. Red, green. But you don't see multiple red bars, multiple green bars in a row. If it starts to crisscross the 20 MA, to go through the 20 MA, that means it has no momentum either. So, okay, so those are kind of my top 10 rules for trading the level 2. And again, the only one that's not a must would be the catalyst. And sometimes, like I said, I will trade the stock purely off the level 2 without even looking at the chart. But that's when the environment is good for scalping. Once the market, we're in a bear market, no doubt about it. Once the market starts to accelerate, starts to fall apart a little bit, then you start to hear about it in the news every day. Remember in in March, or in 2007, 2008, when the market was every day, the front page of whatever it is that you were reading or looking at, the first thing you saw was the market. People were talking. People were talking about the market. When the market starts to get going, and I know we've dropped a lot, but when it starts to really tank, the level 2 will be will be probably the main thing to do. The last couple of years, I'm gonna stop this. I'm gonna rebroadcast here in a second, but I'm gonna stop this screen share. Let's see if it'll work, and rebroadcast in a second here. But basically the last couple years I mostly did. So how do I do it now? Let me see. So this one goes down. Let's see if I can now reproject. And I'm reprojecting my desktop. Okay, there you go. I was able to. The last couple years, that's what I mostly focused on, is scalping. This account I mostly used it for scalping. That's last year, by the way, and it wasn't even taken at the very end of the year. At some point before the end of the year, that's over $1 million from scalping. That's why I said it's for serious traders. It's a serious strategy. You can make really good money. That's 2021. That's 2020. But that's only 9 months of the year, because I opened the account in March of 2020. That's 900K. I don't know if you can see it. So, and most of the names, if you look up these names, most of them were low priced, high volume stocks. So, scalp them. Why not? And so again, that's what I saw somebody ask what kind of account size. 100K. It's fine. You can start with any account size. That's that's over 25K. You can start with any account size. Doesn't have to be what kind of account do you need for day trading? What kind of an account do you need for? It's the same. So it's the same thing for scalping. For day trading, you can, if you know what you're doing, you'll probably make more money having a larger account. But larger doesn't always mean better or better result. I just need about 100K would be great. A little bit more, sometimes I can use that. Right now, I could probably have the same exact result with 50K. I don't need more. I'm pretty sure I don't need more. Okay. All right, let me field some questions and then we'll get back to trading. Nice SKY, no jinx. James has a call on it, looking great. And then there's a few things that I'm seeing here, but we'll get to trading in a minute. So how big of an account to make the 195? I had two accounts actually. One of them was I don't know. I mean, we can go back and look, but I pretty sure I didn't have more than 40K in it, in one of the accounts, and in the other account, I had 100K, 105,000, because the limit was, they told me, oh, you're opening a portfolio margin account, which gives you better leverage for overnight hold, but doesn't give you better leverage for day trading. They said the limit was 100K, so I opened it with 105. So one was like 40K, I believe. One was 100K, 105, and in 7 days I made 195K, something like this. Let's see. What about the whole thing about hidden shares on level 2? The imbalances you look for are so great. That's a non-issue. Yeah, so during slow periods, they can easily hide some of the shares. And you might think, well, I got, this is RLX. I got 33,000 here, 140, let me short it. And you short 30K, let's just say, and it doesn't even budge. You're like, what's going on? Yeah, they can hide. But when the market starts to move and we start to get the momentum back that we don't have right now, we don't have very much of right now, they're not going to be able to hide the shares, to hide shares. You'll start to get the fluidity. And then, hopefully we'll get the level 2 back to how it was. Can you make a more detailed example or bid an example in what entry level price you would put? So I don't exactly know what you mean. So that's the bid, that's the offer. When the offer is really weak and the stock is bullish and is about to break out, that's when I jump in it long. So I showed you in the thing a few level 2 examples. I can show you a lot more, but I can also show you live as they come up during the day. But hold on, I can show you some more if that's what you're asking, but let's see. So basically this is what you want. These are the kind of level 2s that you want. That the imbalance, the offer being much stronger than the bid. 400K versus 10K. 50K versus 3K. 30K versus 29K versus 16. See what I mean? This one, ignore. Something else. That's what you want, basically. That's what you want. Okay. Let's see. In light speed, how do we get the totals bid and offer? Yeah, some platforms don't show it. Some platforms unfortunately don't show it, but E-Trade does, and Sterling does. This is Sterling, which I got from T3, which I get from T3 Trading Group, and then also E-Trade has the totals. You just have to make sure you click on depth summary. If you check, make sure that's checked, Then it shows you the total at the highest bid, lowest offer. Okay. So E-Trade Pro, and then Sterling have it. Many other platforms do. Let's see. Do we need to combine the level 2 with the... It's helpful to combine the level 2 with the time and sale. Here's why it's helpful. This is the time and sale. It's a good question, by the way. This is the time and sale. Here's the level 2, and I don't even show that when I have them combined. I don't even look at it, just like so. Just the price and the size. It's helpful because in order to know whether the stock is being sold or bought, you want to see a lot of red, a lot of green. If you see a lot of red, then you know the stock is getting sold right now. If you see a lot of green, then you know the stock is being bought. So I do combine them. So that's a good point. Absolutely. Most level 2s come combined. Like I showed you on E-Trade. It's just combined. But sometimes there's two separate windows. And so yeah, I do recommend having both open next to each other, just like so. You don't need to get to the exchange to know where it's being sold. Like you can, you can add exchange. You can add additional detail. You don't need any of that. I just look for the color basically, and I'm not staring at it. I just have it next to the level 2, and I can see whether it's red or green most of the time. Any other color and it means something else. It means it's like an inside, in between the bid and the ask, but just the red and the green, and the total is what matters, and the stacking. The more stacked it is, so a lot of shares. Let me open it up a little bit more. Look at that. The better it is as a short. But you want to make sure also the stock looks good. You want to make sure. I showed you examples of what it means to look good. What kind of plays you want to look for. And that's what I do. That's what I basically scalp. Let's see. Why don't I trade options? I never got into options really. It's just, I always traded equities, but nothing wrong with it. Feel free to do it if that's your thing. I just never, I don't trade everything. I trade certain things, and I got started when I started trading on my own. I got started with equities, not options. But if that's what you want to do, I think options are probably there's more variables, probably more complicated, but give you better leverage. And then there was another part to your question, which was, let's see, ADRs, because most of the time they don't move very much. Most of the ADRs, let me get this out of the way. Most of the ADRs, they just end up with a narrow range bar every day. Ericsson is an ADR. Sometimes they move a little bit when they gap or when there's news. Sony used to be but maybe it's SONY. See, most of the time they don't really move. Again, when it gaps, maybe okay, but the vast majority of the time they just don't move, and therefore, you're not gonna make money trading them there because they won't move. Okay. Haley, I'm guessing on your scalp trades, but on chart trades, do you ever take the extra step of entering a show size on your shares? I don't. I never hide my shares because it puts you at the back of the line. At that price level, if you hide your shares, your order will not get priority. So if there's a bunch of people entering orders at the same price, and you decide to hide your shares, you will be at the back of the line. You'll be the last order to get filled. So I rarely hide my shares. Rarely. When you scalp, where do you place your stop? How many cents? 1 cent most of the time. Just 1 cent. Sometimes if the stock kind of is wiggly, jumps around a little bit, then I might give it a couple cents, but most of the time just 1 penny. Is there any other platform that gives you aggregated? Okay, as I said, I know of two. I use two that give you that aggregate the volume or the share size, and that's Sterling and E-Trade. Oh, please explain the reason the total amount of each swing trade is different, even though the risk size and the risk per trade are the same. Yeah, so the question is, this is also the same with day trading. The question is, if you look at, this is a newsletter. If you look at the newsletter and you look at the share size columns, so if you look at the shares, so under $1,000 risk, let's just say, doesn't matter what column you pick, but let's just pick the $1,000 risk, and you look at the stock entry price is, I don't know if you can see, can you see the entry price? Yeah, you can. Was $20, 2012, and the total shares are 248. Well, $20, well, 250 shares times $20 is $5,000. Versus, let's say, 100 shares times entry is 234, that's $23,000. So why, and yet I'm saying that's still $1,000 risk. How could that be? On this stock, I'm trying to get $23,000 versus only on the flex only $5,000. And I'm saying that's still a $1,000 risk. How could that be? Well, the risk is the difference between, here it is. The risk is the difference between, it's your share size times the stop size. And the stop size is the difference between the entry price minus the stop price. So in order to, so a lot of people, what they do is they always buy or short or, 1,000 shares of any stock. They trade Apple, 1,000 shares. They trade Bank of America, they trade whatever it is, it's 1,000 shares. Or they always do, $5,000 or $10,000 worth of stock. So if it's $100 stock, let's say they did $10,000 per play, they do 100 shares. If it's a $50 stock, they do 200 shares. And they think they're share sizing properly. They're not. You share size properly by figuring out where your entry is, figuring out where your stop price is, and then calculating and then figuring out what you intend to risk, what you're comfortable risking, $100, $50, $1,000, $2,000, whatever it is, you're comfortable losing, and dividing that amount by the difference between the entry price minus the stop price. So that's how you share size properly. I do have, let me show you real quick. We do want to get back to trading here soon, but I do have something I can show you real quick. I've done a whole webinar on how to share size properly. In fact, if you just type in YouTube how to share size properly, probably that's the first thing that's going to come up. Okay. Well, let me show you what I mean in just a second. Don't want to do another whole webinar. But let me show you what I mean in just a second here. Huh. Can't find it. Looking. Give me a second, please. Oh, there it is. Wow. It was in front of my eyes. So here you go. I'm not gonna project it right, but try to get it into the window here. This is just a power. So here it is. So basically, before you opening a position, we can predetermine our potential risk and reward in every trade. Your risk is the difference between the entry price minus the stop price times your share size. So and then your reward is the difference between your target price minus your entry price, right? So for example, let's say you wanted to get in at let's see 44.18 and your stop was at 43.98. Your target was at $45. Let's just say 44.98. How do you calculate your share size? Your stop size is 20 cents, which is the difference between your entry price minus the stop price. If you're risking $100 per trade, you take $100 divided by 20 cents, gives you 500 shares. Now 500 shares of whatever the price of the stock is. It could be a $5 stock, it could be, in which case it'll be only $2,500 total investment, or it could be $100, in which case it would be a $50,000 investment. It doesn't matter. What matters is the stop size. It's not the amount allocated to each stock. Does that make sense? If your stop was $500, then you would take $500 divided by 20 cents, gives you 2,500 shares. Does that make sense? So that's how I calculate my share size. In order to make it easy, simple and easy, I have a table. I have a cheat sheet, so to speak, and it's uploaded in the files folder. So if you go to the room over here, go to the files folder, and it's called share sizing table. Download it, and you'll see what I mean. So let's download it here and open it up. It's an Excel sheet, and it's gonna look like that. That's what it's gonna look like. That's the table that's taped to my monitors, to my monitor in front of me. So for 5 cents, I take 10,000 shares. I do the stop size, calculation in my head. It's the difference between the entry price and the stop price. 6 cents, 8,300 shares. 7 cents, 7,100 shares. And then when it gets a little bit larger, a range. I don't need to be too precise. I just say between 23 cents to 28 cents, I'm taking 1,700 shares. Between 29 cents and 36 cents, I'm taking 1,300 shares. This is available for you to download, and you can just change the risk amount. Change it to whatever it is that you use. Let's say you use, you risk $300, just change it to 300, and then the formulas will update the numbers. 400, 100, so it's available to you. Got it? So that's how I share size. So it's not, based on a certain dollar amount or a certain number of shares invested. Not at all. It's based on the risk per trade, based on the stop size, and whatever amount you're trying to risk on that trade. Okay. All right, guys. But the time to calculate the proper share size is time that you could miss the entry. Yes, you could, but sometimes you just eyeball it and you know exactly how much you should get in or out. 1 second, please. CLVS, you might want to take some CLVS. So get good at, just get used to calculating the stop size in your head, and then the cheat sheet is in front of you. So it's a useful tool to just to look at. All right, I mean, useful sheet to just glance at. So, but just get used to, calculating, okay, I want to short this right here under 71.84. I'm going to put my stop at 73.15. You can take out a 10 key calculator and do it, or I just say, well, 71.84, 73.13, that's $1.30. That's $1.30. Then I go to my cheat sheet, which I closed out of, and I see how many shares I should get based on a stop size of $1.30. Now it's not always this complicated. 78, 71.84, 73.13. Some people might find this hard to calculate. What if it is, like a simpler number? The entry is at $50, stop is at 49. Oh, that's $1. I know exactly how many shares to get if I am risking $100 and the stop is $100 is $1. 100 shares. I don't even need to look at the cheat sheet, the share sizing table that I showed you. Does that make sense? So after a while you get used to it. In fact, after a while you don't even need to look at it most of the time. You just know how many shares to get, how much to get each time. And sometimes you end up oversized a little bit, undersized a little bit. The goal is not to be precise, exact. The goal is to be close to risk about the same amount every time, so that you don't have wild money, just wild P&L swings in your P&L. The goal is to be steady and risk about the same amount, and it should be an amount that you're comfortable with. And it shouldn't be, if you lack the experience, it should be as small as possible. $5, $10, $3, $20, $50. If you can't make money with $20, risk, you're not gonna make money with 200. That's a guarantee. So that's how it should be, okay? All right, thanks, Amber. How long do you stay in most scalp trades? What are your cues to get out when the level 2 flips? It could be seconds, it could be minutes. I've stayed in scalp trades a whole day before they moved sometimes. And sometimes I've done 100 or 1,000 trades, felt like 1,000 trades on the same stock in the same day. Maybe not 1,000 trades, but 100 trades on the same stock in the same day. So, it depends. We're always, as human beings, it's just so much easier for the brain to compartmentalize, whatever the word is, to put everything in a box. It's just so people ask me all the time, oh, how many, what volume should I look for? What's this or that? But there isn't always an exact number. You can't fit everything in a box. Trading is more of an art than a science. It's a science. You need to learn the science behind it, and then you need the artist to come out of the shell. So it's an art and a science. Okay. All right. So